Welcome to this explainer covering the latest KINGFINITY Insights newsletter from the first week of August 2026. What's truly fascinating about this week's data actually isn't the Bitcoin price, which has been holding somewhat steady around $63,800. No, the most crucial story happening right now is a massive structural shift occurring right beneath the surface. We are moving entirely away from the industry's historical obsession with pure distribution, and we're pivoting hard toward hardcore control.
Wider access in crypto? It means absolutely nothing without the rights, records, and security to back it up. If you're building, investing, or even just participating in this space, this is the real infrastructure you'll actually be relying on. We're looking at a market maturing in real time, focusing way less on the fleeting hype cycle and much more on the foundational plumbing that makes digital assets viable for the long haul.
Today, we're unpacking 5 distinct reality checks. Banking goes on-chain, wallets are not records, testing the trust layer, AI compute as treasury, and finally, the accountability metric. Let's get right into it.
It really all boils down to this fundamental tension, beautifully summarized by KINGFINITY Insights. Wider access creates value only when rights, records, security, and governance remain credible. It's one thing to blast a digital asset to 1 million wallets in seconds. That part is getting incredibly easy. But ensuring the security and governance backing that asset remain absolutely bulletproof, that remains notoriously difficult. And that is exactly where the next stage of digital asset infrastructure is going to be won or lost.
Section 1. Banking goes on-chain. Realities of 24/7 money. We're seeing major legacy players make some decisive moves right now. Wells Fargo is actively planning limited tokenized deposit rollout this fall, starting specifically with 24/7 USD to GBP transactions for select corporate clients. They're hunting for that always-on instant settlement. And at the exact same time, Mastercard just completed its acquisition of the stablecoin infrastructure company BVNK. The traditional financial world is actively wiring itself into the blockchain.
Remember the old adversarial narrative? The one where programmable money like stablecoins would just completely wipe out traditional banks? It was always positioned as this zero-sum game. But the emerging reality is actually much more cooperative. The future financial system is going to feature commercial bank deposits and regulated stablecoins operating seamlessly side by side. The old war is over, and deep integration is the new paradigm. Because of that deep integration, the conversation has matured into some highly critical infrastructure questions. Think about it practically. If you're moving millions across global networks at 3 a.m. on a Sunday, you need absolute certainty. Who carries the liability ownership? What are the exact redemption rights? Are there traditional deposit protections in place? And how do you handle cross-network compliance, liquidity, and reversibility? Programmable money demands speed, for sure, but it absolutely demands clear accountability.
Which brings us to Section 2. Wallets are not records, the tokenization reality. We're seeing some massive rollouts bridging traditional assets to the blockchain, and Ethereum's institutional footprint is expanding at a staggering rate. Take Dinari, for example. They recently launched access to over 700 tokenized U.S. stocks for eligible investors. Meanwhile, BlackRock introduced 12 Ethereum-based share classes for selected European money market funds, using Connexus as a critical translation layer between traditional funds and approved blockchain wallets.
But here's the sober reality check. Seeing a token in your self-custody wallet does not legally mean you own the underlying asset. Wallet access does not automatically define legal ownership. If the authoritative legal register says otherwise, your token is basically just a picture on a screen. Access is merely a product you offer to users, but actual authorization, the legally binding right to the asset, is the heavy infrastructure we are still figuring out. To bridge that gap, investors still require an entire stack of corporate scaffolding to make tokenized assets genuinely functional. You need to identify the authoritative register, enforce transfer restrictions, process redemptions, manage corporate actions, and define the ultimate settlement asset. So, a quick reality check on recent headlines. When you see reports of $311 billion associated with BlackRock's tokenization efforts, remember that relates to the broader fund's range's total assets. That money isn't just magically sitting on a blockchain without traditional, heavy-duty custody guardrails.
Moving right along to Section 3, testing the trust layer, bridges and custody. Consider the real-world pressure on both ends of the custody spectrum today. On one side, pure self-custody has critical vulnerabilities, like the recent technical flaw discovered in how secure keys are generated on certain Coldcard hardware wallets, which forced users to urgently move their funds.
Juxtaposed against that risk is a massive push for crypto's institutional trust layer. You have banking giants like BNY actively planning to integrate Galaxy-powered staking directly into their highly secure custody platforms. To understand the sheer scale of security needed today, just look at this number: $7.4 billion. That is the massive amount of wrapped Bitcoin that BitGo is currently migrating to a cross-chain messaging protocol like Chainlink CCIP. Following recent high-profile security incidents on various bridges, this massive migration proves that interoperability and bridge security are no longer just technical details left to developers. They are literally board-level security controls. The big takeaway here? Debating self-custody versus institutional custody is fundamentally way too simplistic. Custody is not a static product you buy off a shelf. You have to evaluate custody as a continuous control system. Every model has to prove itself against intense operational stress tests, starting from key generation quality and verifier diversity, all the way down to asset segregation, automatic circuit breakers, and completely transparent incident response protocols.
All right, Section 4. AI compute as treasury, megawatts to value.
Let's explore a fascinating trend. Crypto treasuries are suddenly morphing into AI financing engines. Look at this staggering figure: $4.7 billion. That represents the 16-year base term value of Bitdeer's newly announced 121-megawatt Norwegian AI and high-performance computing lease. This isn't a small pivot, folks. We are seeing miners and crypto infrastructure companies aggressively repurpose their immense power resources to feed the AI boom.
And if you thought that was massive, check out Hut 8. They are reporting a colossal aggregate base term expected value of $26.6 billion across 949 megawatts of contracted AI capacity. These numbers are absolutely astronomical. They reveal a tremendous pipeline of global AI infrastructure that is actively being funded and facilitated by crypto-native companies who literally hold the keys to the power grid. But as the source analysis rightly points out, there is a huge gap between announced contract value and actually collected revenue. To realize that cash flow, you have to overcome the brutal reality of construction and capital expenditures, underlying power economics, tenant credit reliability, and complex financing rights. This shift is even forcing protocol treasuries to think entirely differently. Look at the Near protocol, which is currently debating a sovereign fund proposal. They're asking incredibly tough questions about protocol treasury governance when deploying crypto capital into highly complex, real-world physical infrastructure.
Finally, Section 5, the accountability metric, beyond the hype. Even in the retail sector, away from institutional high finance, things are drastically shifting. Meme liquidity has rotated. Platforms like Pump.fun have made token launches absolutely effortless. But because that barrier to entry is so incredibly low, the market is now aggressively demanding much better quality control. Frankly, users are exhausted. They are tired of the constant rug pulls and the zero accountability culture that has dominated the meme token space. While new platform features might improve short-term token graduation activity, short-term movement simply doesn't prove a platform's actual quality. We need metrics that prove durable platform quality. We're talking 30-day launch survival, verifiable creator earnings, auditable fee allocation, token burns and unlocks, and truly meaningful moderation outcomes. Reduced churn is the only real way to build durable trust in the retail launchpad space. So I want to leave you with this provocative question drawn directly from the KINGFINITY Insights prompts. If the blockchain wallet is not the authoritative ownership record, what information should remain on-chain? If distribution is easy but trust is hard, how do we rebuild the definitive record of ownership for the next decade of digital assets? It's a massive question that every serious player in the space is trying to answer right now. Thank you so much for joining me for this explainer, and keep questioning the infrastructure.